So good afternoon, everybody, and welcome to ARC's fourth web window on business cycle and COVID-19 update. My name is Anne. I'm the moderator for today's session. So without any further delay, I would like to pass over the word to our today's expert, Florian.
This update that you see here was prepared in November already. So we are working continuously on tracking the crisis, and this is sort of the end of year summary that we have prepared. My name is Florian Köthner. I'm leading the European team, our analyst team, and I prepared that basically with the complete team here in Europe. And we were wondering if there is any catchphrase to summarize the crisis of 2020, and what is the common theme. And we all always look back to previous crises. It was the financial crisis of 2009. We had a dot-com crisis. We had several banking crises even before that. We had the oil price collapse in 2016 and so on. This time, it's different. So wherever we looked, whichever reference we took, we sort of were unhappy because, well, this time it is different. There are a couple of things that are significantly different than in the past crises, and by now we can certainly say don't compare it with anything that has been before. It is severely differentiated from anything we had seen before. And just to prove the point here, what you see here is three indexes, not automation, but we look at the capital expenditures, so investments of users in blue on both charts. We look at the EPCs, so the engineering procurement companies, the orange chart, that is the revenues, right? And the OEMs, so the machine builders, also the revenues of the machine builders. And we sort of indexed at it more or less to the peak prior to the downturn. So again, it's not really the same peak for all of these three curves here as well as here. The idea was really to basically make these two crises comparable. And of course, we are missing a lot of data here, but you see that the financial crisis was far, far more volatile than what we are seeing today. In 2020, also the OEMs, which are super volatile in 2009, are far less volatile. Also, the EPCs are going quite stable. Of course, not all sectors. Machine tool business is not doing well, but overall, the dynamics are completely different, and they are not as severe as with the financial crisis that we had in 2009. So first, the amplitude is different, and second, also the individual players, machine builders, users, and EPCs are impacted differently. And we see that revenues of users lead CapEx by 1 to 3/4 over the last year. So typically, the revenues drop first, they peak, they drop, and then the CapEx, so the investments, follow by a couple of quarters. And that was quite in 2008-9, that was quite at the same quarter. But here, actually, we have a lead again of the revenues for the investments. I think it's one of the very important aspects that we have to keep in mention, that in 2020 none of the markets were hit in sort of an equilibrium. Automotive had a structural change. Already were down far before the corona crisis and had big problems there. We had a positive cement shock in 2010 and 11, which led to over capacities in China because the country was pumping so much money into the market to push investments that only by basically 2019, all this was sort of squeezed out of the market, the overcapacities, and then the COVID crisis hit. And we had several oil and gas price shocks. Of course, we had the 2015 shock here. That was mainly the commodity markets, what we see here, the dip. But then again, we had negative shocks this year. And so it's very important to see that the current crisis cannot be, or the current dynamics cannot be understood without going a few quarters back. What we also learned during that crisis is that in the past we tracked markets annually. So ARC started in the mid-80s to track markets annually with the studies. Then in 2000, we started with the first CapEx, and now we are significantly increased the coverage with those indexes on the quarterly basis after the starting 2010. And this year we introduced something else. We introduced the sentiment index. And at this time, that's the only time you will hear from me. Please put out your smartphones, take your camera, and make a picture of that QR code. This QR code will put you to a 2-minute survey. Most people are able to do it by 1 to 3 minutes. So it really takes 2 minutes around to complete it. It's 3 simple questions. One is about current situation, this month and next month, and all of these questions just have 3 answers. Basically good, bad, neutral, or better, worse, and same. So please take out your smartphones, participate in that survey. It's at the end of the month, or at the beginning of January actually, you'll receive the December results, and we are going to create these indexes. These indexes are the result of exactly these questions. So let me just quickly explain to you what we see here. We see the current situation. We ask, is the current situation good, neutral, or bad? If everyone would say bad, we would end up at 80. If everyone said good, it would be 120. And well, 100 is sort of the base, the neutral scenario. So what we observe right now is this month compared to last, etc. So current situation is sort of evaluated neutral. We also see a pickup in a lot of the other, let's say, indexes. So the revenues are going back up, and the situation has sort of stabilized. We also would expect we also expected this index to go up. You see here next month these 2 indexes were going up. So, and then this one followed. And then next month, which would be December, we expect to go down a bit or remain stable. So COVID forced ARC to go from annual to quarterly to now monthly market tracking. And again, by taking a picture of that QR code with your smartphone, you're able to participate, and highly welcome to do so. Now, this is one thing, right? So we have the sentiment index, which indicates right now we are in the end of 2020, we are in markets that are starting to stabilize. Then we also have these traditional indexes where we look at the revenues and investments from the companies. And we do that since quite a while. And we really adopted that to reflect the markets. I want to share with you something on the methodology of seasonal adjustments and smoothing. And I know I am a data nerd, but this time I think it's really relevant because people can do a lot of irritating things with data. So what you see here is the smooth line of our automation index until Q3, which is the last data point here. And then you have the raw line. So you see raw line has a much sharper drop, and then a big recovery in Q3, which is when a lot of the fiscal years end. So fiscal year Q4 is typically a very good quarter. And if you would go back 1, 2, 3, you will actually always end up with these spikes being in Q4 or so. So the point is now we cannot rule out the fiscal year effect and the COVID effect because it's so new relatively, because we still only have 2 or 3 quarters of data with COVID. So it's very important to look at always both effects. Now the smoothed data, the seasonal adjustment data, would indicate it's not all that bad, right? So -5-ish sort of for 3 quarters. While the raw data would indicate, at least for Q2 2020, that we are in a very, very, very big crisis. And obviously after we've gone through a series of additional quarters, those filters work better and they show you the real picture. And for the next slides that I'm going to share you, we will actually go through some of the industries and we will look at raw data and smooth data, and we've chosen the data to really be meaningful. So be careful right now what you look at in terms of data. So next, we're going to look at the industries, discrete, hybrid, and process. We track much more industries that I'm going to share with you right now, but it's simply out of matter of time that we're focused on the really key industries. So you see robots. Robots mean discrete. Now you see here, this is definitely raw data. What you see here, and that you will also see for the following slides, I'm going to explain that once in a bit more time, is that we'll see the blue line is the revenues of the automotive companies. So you have everyone from BMW to Volkswagen to Toyota, Ford, everyone is here in those, and these are their reported revenues. Out of the same sample of companies, the reddish line is their investments. The gray line is are the machine builders. So we look at the, let's say, representative sample of machine builders for the automotive industry. So we have, of course, a lot of machine tool builders there. We all, but of course, we don't have textiles machinery on there, or we don't have oil and gas drilling machinery in there, or mining machinery. So it's a representative sample of machine builders, and which can indicate a basket for the automotive industry. And the green ones are from our own ARC studies, and therefore it's not quarterly, that's annually. We have the automotive revenues in our studies, so it's automation hardware as well as software and services. And then I also added the current forecast for 2020. Now, as you see here, the downward trends really started quite early. That has to do with the structural adjustments due to the e-mobility, and that really hit the machine builders first, while here automotive was, in terms of revenue, still stable, and also they kept a bit of the investments for, let's say, new production lines and batteries driven of battery electric vehicles, and also digitalization. So some of the investments continue. Revenue remained high, but you see here that the investment crisis of the automotive industry started as early as summer 2019. We had a restart of vehicle production in most countries by April, June, and right now China again pulls the whole industry. We have big revenue losses, we have challenges in the global supply chain, we have lower income in the service sector, which service sector being now, let's say, restaurants, bars, as well as entertainment. So these people have simply less revenue, so they can't afford cars. We have home office, so less kilometers driven, less wear and tear on the base which is out there. And also the governments have been not so free with saving the automotive industry like they have been in the past. So overall, the corona crisis hit the automotive markets, but in already a period of transition. Many now call the reason of the troubles the crisis, but in fact a lot of the transition started much earlier. We would expect that these markets, these automation markets, would come back to 2019 level by 2022, or even later if you look more on the machinery side. On the bright side, we have electronics. So electronics they have very clear investment cycles. It's basically a 2-year cycle. Hence, we also here have the smooth data. It's very easy to spot. And we don't see a big impact, at least on investments, from the corona crisis. So these cycles basically continued. The revenues dropped a bit, but overall it was quite a stable market. It depends a bit on which electronic market you look at. Is it entertainment or is it washing machines? But of course, people have less money available because of rising unemployment rates. That really impacts demand. But the new chip generations and anything else wasn't really postponed. So we would expect that the overall year 2020 is quite good for electronics, but then we actually have a contraction in next year, 2021, and then 2022 rising markets again. Semiconductors, the last discrete industry before we turn to hybrid, come out of a, let's say, phenomenal boom phase over a couple of years, and still 2020 was a year of investment. For automation markets, we expect that to be stable, as well as for the CapEx basically start to drop down. But overall, a very, very good year in one of the markets that really stabilize the overall industry of automation. So always have that in mind if you look at the top numbers, which I'm going to present to you at the end, that there are big difference between the verticals. And one of the verticals which were also quite stable were, of course, the hybrid markets. Hybrids markets being food and beverage and pharmaceutical. And I'm sorry for the German quotes here. That means the pasta is safe because we have all those panic purchases where we had empty shelves and there was no more pasta. Everyone didn't know what to do, so all Germans purchased pasta. But the markets overall, they were under a bit of stress. Selected markets were down. I'm here in Munich. The Oktoberfest didn't take place, and yes, that had a big impact on the brewing industry. Other markets also had weird effects, like the potato market was under stress because people don't make French fries at home, they eat it outside. But overall, the market is comparably stable. We can see continuing investment in digitization, including track and trace and serialization. We also observe a higher share of automation on the agricultural side of business, and we see that the production is moving closer and closer to the consumer. Not only talking about urban farming, but really just producing quite close to the consumer. One last comment here: the Brexit can have some really odd effects, as the UK imports 60% of their food in winter times from the European Union. So this can have really odd effects. Pharma, we had panic buying for certain pharmaceutical goods. Anything that can fight the common flu. Hygiene products here are not part of the pharmaceutical market, but would be household goods or even pulp and paper. But we had some panic purchases on selected medicine. Overall, the social distancing actually led to a drop of the common flu as well as colds. So has a positive impact here. But of course, there are investments for the vaccination that are now ongoing, and overall the market is quite stable. So overall pharmaceutical limited impact, if not even positive impact from the crisis. So going to the process industries, and to one of the most interesting markets here is the chemical industry. The chemical industry, if you look at these cycles, it's basically was already on the slight downward slope in 2019 for revenues in blue as well as CapEx in red. So actually the corona crisis accelerated a lot of the anyhow ongoing trends, and we typically have those 3-year cycles in the chemical industry, which also means that as the COVID crisis accelerates this and deepens it a bit, we would expect quite a long time until the chemical automation markets bounce back. We would expect 2024, 2025. Really interesting is that we are in the middle of a transition period also in the chemical industry. So we have the digital twin of the production facilities, which is really catching on. It's used more widely across the end user community. So they set up a digital twin of the existing plants, or with new investments, they want the digital twin as well for the maintenance, for the training and everything. So this really is an ongoing trend. We of course have the modular type package, so modular production in chemical and fine chemical industry, which is going to continue and is currently well on the way. We also observe that during that crisis year, if somehow possible, and accessing the plants, the company used the opportunity for maintenance repair business, maintenance, repair and operation and services. This is this year, because the plants were shut, the output was not needed, and you can actually go in, do the service, do the modernization and retrofit, etc. So again, if there wasn't a severe lockdown, strict lockdown, you could go in. That was actually stabilizing the automation markets. But again, already in downturn, and then COVID really accelerated things. Until now, the mining industry didn't really show such an extreme impact from COVID. We expect the mining markets to be back on track in 2022. So the mining automation markets, to be precise, to be back in 2022. We typically have quite large cycles, but we already went through various periods of consolidation where large mining companies acquired smaller ones, and that will also continue. So the crisis puts really smaller mines under pressure and forces the next wave of consolidation. All right. Then oil and gas. Yeah, oil and gas, of course, we all remember that there was a time in 2020 where we actually had negative oil prices. So oil price, which is not only a supply and demand mechanism, it depends a lot on politics. How good the Russians can deal with the Americans, with the Saudis and everyone else. So it's not that easy. The oil price is the main driver. The demand is of course down. We have lower industrial capacity utilization. We have less kilometers driven in cars due to lockdowns and home offices, travel restrictions, and because the travel restriction caused flight traffic and to contract by 80–90%. So we expect that after these wild swings, the markets would stabilize in 21. We don't really see big new projects coming up. Investments is again in maintenance, repair and operations. So again, modernization, retrofits, maintenance, this one. And interesting enough, if you read some of the annual reports, Exxon mentions they reduced capex by 20%, and Sinopec, out of political reasons, maybe they don't even mention COVID-19. It's not really a thing in their report. We expect a further consolidation of the North American oil market because that was financed by depth, and the drop in demand will accelerate things here, and then a very slow return to 2019 levels. If you look at the, let's say, long-term outlook, it's interesting that the discussion has moved away from something like peak supply, which we all know, like we had the peak supply and afterwards there will be less and less oil, but now the discussion is on peak demand. So will the global population use less oil than today in future, and when will be the peak, when we will hit the peak demand, because we get less and less reliant on carbohydrate energy. Again, that was a very quick run through the industries, and I certainly skipped a bit. And if you have any requests for certain industries, let us know. We can certainly help you, but due to the timing, I need to restrict myself here. And so here are the conclusions from the industries before we go into the machinery markets and then conclude with the automation markets. If you look at the current situation, you can come to two conclusions. Number one, the whole thing is basically over. Everyone invested in digitalization. It was not that bad, and that's it. Have fun, enjoy the recovery to come. That is the optimistic view. The optimistic view basically saying, we now have the vaccination, it's going to continue and everything. But again, the markets weren't hit in equilibriums. It's not that everyone was super healthy when the crisis struck. So another conclusion would be what we saw on the investment goods market was just the beginning. CapEx will contract further, also causing machinery markets, EPCs, and automation markets to contract further. That what I said also earlier on the seasonal adjustments, right? We had the big, let's say, bounce back in Q3, but this may just have been an effect of the fiscal year, and then it may drop down further. So, and my own interpretation right now of the status quo is a bit like this. It's something in between. It's sticky like chewing gum. We won't really get rid of this at least for another year and a half, and we will have to live with the short as well as the long run implications of the COVID crisis for quite some time. And this is the forecast that we made on the CapEx side for the users, on the EPC side and the machinery side. And you can see here, so the numbers aren't really that meaningful, but if you just look at the wave here on electronics, we have contraction, expansion, and then we have another contraction next year because of these investment cycles that I mentioned. Automotive and aerospace hit early, hit hard, but then the rebound. And then you have some of the markets in the process industries which are hit hard and where we don't expect a very fast revamp to come. Again, we will live with the consequences of COVID-19 economy-wide for quite some while. Now let's have a look at the machinery markets. Let's move to an overview here. We had a significant but not critical drop in the machinery markets in the first half and first 3 quarters of the year. Machine tools were certainly the most impacted, but again, that is not only the COVID crisis. That has something to do with the structural crisis of the automotive industry, and also machine tools the machinery is very, very expensive, which makes it more volatile to any sort of market, to market development. But this comes from my colleague Stefan. He is doing 24/7 machinery markets, and his description is really significant, but not critical drop. And again, we see here on semiconductor and electronics, these are the machinery builders. They had a very good 2020 in semiconductors. Electronics, I consider that stable. Don't be too detailed here, but it's almost stable. So the investments in these industries is really going on. And then when we look into more details of the individual machine types, again, you can see textiles was impacted far earlier. Also, oil and gas and mining, those were started to get impacted in 2019 already. Again, we're coming out of a crisis here in these machinery sectors, which barely any recovery, at least not in the oil and gas side. What was also quite interesting, that it's the first time since quite a while that robotics markets are not booming. this is not a structural thing, but automotive is still the biggest user of industrial robots. So we are very sure that this market will come back very, very, very strong. And we have the semiconductor quite big, but overall, most of the markets here, of the machinery markets, are impacted, and the most impacted are the ones which are directly linked to automotive. Going one level deeper from end users to machinery, now to the equipment that powers the machinery, the automation markets. And as many of you know, we track the markets in terms of regions. So Americas, Europe, and Asia. And for Americas, I've provided I think for all of them, we provided the raw index. Yes, it's always the raw index because of these bounce back. Again, this bounce back, be careful about that. It could be that we're expecting another drop because this may just be a fiscal year impact. But again, the sentiment index would expect a more stable Q4. We'll see. We're just doing the sentiment index for half a year, so we have to see how to interpret this, all of this. Americas is really, I would say, a problem child here. Not only that the oil and gas industry is very important here, and I mentioned earlier we're expecting consolidation. We also have a very strong impact on the aerospace industry because the main player, Boeing, was really squeezing the value chain previously as much as possible, so there are not many reserves there. And of course, the almost complete lack of any COVID strategy leads to a staggering number of deaths, which is already exceeding or reaching a level already where you could almost speak of a new level, because we lack people, we lack consumption, right? Because of straightforward dead people. So we are very concerned about the markets. I hate to be that cynical to speak about that and then talk about markets again, but this is our topic here. So we have to consider, we are now playing with, in our heads, we're thinking that Americas may reach a new normal. We may have normal growth rates, but we may just start with 1 or maybe 2% less market volume in the Americas. Europe, also here we are in the middle of the second wave, or is it already the third? Let's call it the second. Also, Q3 was quite good. We had the upward trend, but also our biggest automation supply here had the end of the fiscal year in Q3, so not that clear. We actually saw the market were not that big impacted, but it can still be. We are quite cautious about Q4, maybe even Q1, as the result of a second wave. Europe is also quite exposed to anything in the automotive markets. Well, and in Asia, again, that's the raw index, why you have this funny spikes here and there. In many of the countries there, the crisis is basically defeated. Taiwan is doing very well, China is doing very well, Vietnam is doing very well, and also Japan and Korea, they're dealing with the crisis and pandemic very, very well. Very strict, very concise. We also have the fact, of course, that Asia automation markets are quite exposed to the electronics and semiconductor industry, which again, doing their, let's say, almost standard investment cycles. So this may help. We see China is in many areas already back on pre-crisis level and really pulling the whole global automation markets. And then we, of course, have in infrastructure investments on 5G networks, but also on electricity and grid and water, etc., which pushes the machine builders as well as the EPCs in Taiwan, South Korea, and in Japan. It's also very interesting for us is that's the first time a crisis hit a market where we could see how different business models behave, as now increasingly software is purchased as a service. And the results are, great for those who have mastered the transition. The software market doesn't really had the transition period in 2016 to 18, 19, 20, where a lot of the big player transformed their business from license sell to as a service, more subscription based, and it's much more stable. It's much more resilient. Also, the general trend towards digitization helps, and I would say it's always I'm very happy to see the data reflecting something that ARC is talking for some time about. So again, software markets have been much more stable during the current crisis. And the last thing I want to do today is I want to look back to what we have forecasted in February, March. We had a similar web window in February, March timeframe, where we basically showed the things on the left side, right? We did an online survey back in February, March. How big do you estimate the impact of COVID-19 on your company in 2020? And well, there were some saying no impact. Most people expected 0 to 15%. Some we had 15 to 30%, 30 to 50% drop. And we looked at the industries, and there are machine companies that have this minus 50% drop or minus 30%. And we back then used this feedback to in March have this quantification, and we had those 1, 2, 3, 4 scenarios. The red one was a heavy and long global shutdown, which we didn't have. Back then, that was our assumption. What if we have a really long global shutdown? And for many countries, for some countries, the shutdown was very drastic for a couple of weeks, and then it was eased. And other countries, such as Germany, we have now the second or third lockdown. We had the lockdown light and everything, but we really had this. We didn't have a very long, heavy shutdown. The blue with dotted lines was long shutdown and structural disruption. And then we had one scenario called global pandemic throughout 2020. That was that light red one, which came in our first calculation at around minus 10%, also being in line here with the 0 to minus 20% drop from the survey. And here we are now. On the right side, you see the data, incorporating the Q1, 2, 3 data that is already submitted in the indexes, so from the publicly listed companies. And looking at this, if we don't get a very severe Q4, but sort of Q4 is roughly at the Q3 level, maybe a bit below, we would basically come in at minus 8% automation markets development in 2020. If you're more focused on the process industries, it would be just minus 6, but also the recovery would take longer because we have just longer backlogs until that projects get monetized. So it will also postpone the recovery a bit. I was a bit scared when I did these slides the other day if I dare to make them, but I have to say I'm quite happy because our forecast in February wasn't that bad at all. And I know everyone hates the guy who says I told you so, but in this case we told you so. That was my last slide. Thank you for dialing in. Thank you for listening.
On behalf of ARC, thank you for joining and taking your precious time to view our presentation. Have a lovely Christmas time. Have a great day and stay safe.